all. In fact, I think Ajay Srivastava, the CEO of Dimensions Consulting, is with us. So let's get him into the conversation as well. Ajay, this is becoming tougher to, tread day after day. I mean, we were speaking with a guest earlier in the day, Dipan Mehta, and he said that I just want to wake up in the mornings now because I don't know what I'm going to see on the screen. Are you feeling that way as well? And what is the way to approach this market?
Okay, Sonia, no, I don't feel that way at all, because I think it's all about a perspective as to what you expect the world to do and economy to do. And we have been consistently maintaining the fact that it's going to be very, very tough. This quarter is going to be very tough for Indian markets for three reasons. One, of course, is oil is not coming down. Number two is that there is still so much buoyancy of people wanting to invest. Markets capitulate when you really want to get out. India is a reverse scenario. People are still getting in and getting in by droves, absolutely. There is nothing called sell button for Indian investors. And that's in that kind of scenario, it's the best market for foreign investors to keep selling because we are giving them liquidity. The prices are not crashing the way they should crash. So to my mind, this saga will continue. And more we will buy, the more they will sell because, you're giving a brilliant opportunity to sell compared to a situation where the market actually bottoms out. And our market has not bottomed out. So I think it will be unfair to expect great amount of greens continuously on the screen as things stand today. And you should keep your perspective that this will have a longer-term 6-month impact. And just wait it out. What else can you do? If you're invested, there's nothing much you can do now, can you?
You can't do much, but, there has to be some place for one to preserve their capital. Would you, look at debt as an asset class? Would you look at equities? Because debt as well, even as the interest rates are increasing, there are still negative interest rates, Ajay. So what does one do to save their capital, preserve their capital, so to say?
See, for the last 1 year, I've been sharing on your channels that the way we have preserved most of our capital is by moving them to REITs, by moving them to the investment trust, because these are the two instruments in India which have given very good yields. It's been absolutely beautifully positioned on the price. They've given a price appreciation on top of the dividend yields and still continue to hold firm. So I would still say that the way to do this is to keep your portfolios and the cash instead of in the bank. You rightly said RBI is letting the banks go. We were literally looting Indian investors and depositors by not, even today 7-year FDs and 5-year FDs at 5%. I don't understand the logic. So I think REITs is one good place to park yourself in, and you have the investment trust of the power transmission lines is another place to park yourself. But of course, you must read your risk and returns and everything, etc. But at least that has held us in good stead because, that has given good yields, good dividends, good returns, and kept the capital intact. So I would say more than banks, that's the place to be at this point of time.
Okay. Generally, in hindsight, these are great times for longer-term equity investors to be accumulating stocks, right, Ajay? If one had to create a basket now and start to nibble in, what would the stocks look like?
I think, first of all, Sonia, I must qualify to say that for all investors, there is nothing called long-term. Because if you worry about long-term, your returns become zero at the end of the day. So you need to look at shorter terms and booking profits. I think your mantra has to be book profits. Because if you're not booking profit, you could have seen the bank index going from there to 45,000 plus and back to 34,000, and it's all paper profit. So I think lots of merits of long-term investing, but I would say for most investors, the merits is to book profits because sectorally you churn and you see money in the bank. Having said that, I still believe commodities today represent a very good opportunity. They have corrected the third time in the last 2-year cycle, will give a very good return. Steel plays continue to be good returns to pick up the portfolio. So I would be on the side of producer matrices in the sense of being, in the steel industry, commodity industry. I think that would do well. Some of the monopoly industries would do well. For instance, let's say Multiplex, liquor, I would have said, but the performance has been very, very poor. And I would sincerely believe that at this point of time, getting into one or two private banks would be a good idea. But again, the point says that when you make your profit, book it. This long-term keeping for 5 years is not doing well for most investors. And, it did well in the last decade or so. But world has changed now. We don't buy goods the way we used to buy. So no reason why we should be investing the way we were investing a decade back. So I would say there's nothing called long-term. Take your perspective, book your profit, and that's the way to go with your portfolios now.
What would your thoughts on the IT space be, Ajay? Because, the index itself has corrected about 25% A couple of these stocks, frontline stocks, Infosys, TCS around 25%, Wipro itself is down around 37%. You look at TechM, that's down 40% from the highs. At some point, they will start to look attractive from a valuation standpoint, won't they?
Well, they should. See, okay, if you're an old holder, these are one of the sectors where people got rewarded. But the problem with this sector has become that when the growth went down to single digits, these stocks went to P's of 25 and above. And that's where the challenge started with the valuation of these things. My guess is they will come back. They will start to do something different because the cost pressures will kind of eat up their next 2-3 quarters margin, and then they will start to pick up steam again. So longer term, if you ask me, IT, if you're holding it, I would not say sell it. If you don't have it, you have all the luxury of time to buy it. And that's the beauty. What I would say today is whatever you want to buy, market is giving you a time that there's no hurry to buy. You have all the time in the world. Who has cash is the king today. So therefore, if you like IT, I like IT personally, you will have enough opportunities to buy as we go down the next quarter.
About the market itself, Ajay, a lot of people are still in denial, right? I mean, they're sort of masking this move. Some call it a correction in a bull market. Some call it a pause in a long-term uptrend. But do you just want to say it as it is? I mean, are we staring at a full-blown bear market right now in India, or not? Or is that being too alarmist?
No, I would have agreed with you that see, the economy is already staring at a bear market in real economy. Now, Indian investors do not have a sell button on their mobile phones. At this point of time, if they invest mobile phone, they have no sell button. Now, till the sell button doesn't exist, you will not see a bear market coming through because they'll keep buying, keep averaging, keep buying. And, you know, when you say in denial, I would say only one thing in fairness to all the institutions, that their only thing in life, all the institutions on their channel, investors should understand this, make money only when people invest. They don't make money when people take out sort of equity at that point of time. So therefore, whatever you hear on the channels, communication, media, you got to take it with a pinch of salt because the mandate is to get money into equity, not to get money out of equity. Having said that, I think Indian investors should brace that some of the 30, 40 PE stocks, they will have a real rough time as we go down the path. It doesn't matter which industry they are in, specialty, chemicals, consumer, wherever they are. I think that's the sector at highest risk is FI-owned high PE stocks because those will keep running down. You keep buying, they will keep selling. You keep buying, they'll keep selling. They need to come down. So you are staring at a situation where a lot of the market still has to correct. You know, I'll tell you almost 70%, all the consumer stocks are PEs of 30 and above at this point of time, even with growth is zero. Now, is that a fair proposition? For a foreign investor, he's loving it. He's saying, I can sell at this price. Indian investor, be careful, you're buying a stock at 40, 50, 60 P's, Nestle's, where the growth rate is 8%. Now, does the matrix add up? I doubt it. And therefore, I think that sector, my view, will face the maximum brunt as market, we go down the path into the next quarter.
Well, Ajay, not trying to, paint a gloom and doom sort of scenario here, but a lot of the people that we spoke to over the last couple of trading sessions, they did say that the fundamental valuation of the Indian market is no more than 16 to 16 and a half, 17 times at best in terms of 1 year forward earnings. Currently, we're trading close to 19 times. If you look at the estimates that the experts have projected in terms of earnings and bring them to 16 to 17 times, the levels that we're looking at on the Nifty are closer to 14,000, 14,500. Do you think there is a chance that we go there? And if we do go there, would you be constructive on the indices and the market?
You know, it's hazardous to guess where the index will go to. I sincerely doubt that it will go to those kind of 14,000 kind of levels at this point of time. Because, whatever the action has been taken in terms of inflation and so on, the only variable is oil out of our India control. But I think all those actions should bring inflation down to some extent. The trajectory should start to head down and not up. So having recognized the problem by RBI, they were late to the party, but they've done it. So I think as we go down this quarter is going to be extremely bad. It's going to be a harsh quarter. It's always been a dull quarter. So you'll have to live through this quarter to get to the next quarter and then start your buying spree, what you want to do. And third is index, is very few people do index investing. Perhaps maybe it's the best thing to do because the returns on index are perhaps the best and most funds even can't beat it. Most PMS can't beat it. But the fact remains that index will not go down because a lot of the index stocks also are very, very undervalued. So, and number two is their holding is very strong with Indian institutions. They will not be selling. The floating stock is not too much. So look at the Nifty 50. we don't have too much floating stock in a lot of the companies at this point of time. And therefore, it's all FIs who will sell, domestics will buy, and that story will repeat. So Dow index, I don't think will go to 14,000. I think we'll just have to close our eyes and let this quarter go past. And that's my simple advice. As long back I said, I think a program with Sonia, I said, you'll be well advised to spend the money on a holiday than the market. Perhaps it's coming true.
Now, if you go abroad, you have to spend more money in any case, right? With the way the rupee is going. So I don't know if that is the best advice either. From all sides, I mean, it's sort of you're cornered, right, Ajay? Well, in any case, I guess that's what happens during a recessionary environment.
No, Sonia, I think Indians, we have not recognized the reality of the economy. You know, the K-shape always gives you, because you always move around in a circle which is spending money. Therefore, you don't understand perhaps that what's the gravity of the economic problem, because you don't meet that segment of people who are having a problem. So, and that's a classic of a K-shaped recovery, that the elite class, which is the investing class, feels that it's all is well because everybody's buying a new car, a new house, a new painting, and so on. But the economy underlying, which is 95% of the people, that's the problem, and you don't see them. And because you don't see them, you don't react to it. You know, you don't react to it because you say, the guy bought a 50 crore house, he bought a Maybach, and he bought a Ferrari, and he's gone for a fancy holiday. Things can't be so bad, because he is not seeing the 85% of India where things are bad. And that's where the classic problem comes, is that you start to take a decision on the economy based upon who you see around you, and it tells you it's a pure K-shaped problem which comes in every economy.
Absolutely.
Perhaps less in America, more here.
Absolutely, I take your point. I mean, the gap between the have and the have-nots has gone up quite a bit, right? There's this World Inequality report that comes out every year, and the report in 2022 suggests that the top 10% of Indians have 96 times more income than the average of the bottom 50%. So I guess that's where that K-shaped recovery comes through. But Ajay, thanks a lot for joining us. Appreciate your thoughts. It's not looking like there's any